right now we're in September. We've got a couple 3 weeks, I think 2 weeks till the next Fed meeting. I totally expect the Fed to drop interest rates this go round finally. It's been a long time, and I don't know how much they're going to drop. You can book in at least a 1/4% interest rate, 25 basis points, as it's called, 0.25% of an interest, 1%. But it is possible they do 50 basis points. They don't have enough meetings left between now and December 31st to get done what they need to get done in terms of lowering rates by just going 25 basis points each time. They're going to have to step it up during one of these meetings. I doubt they'll do it this meeting, but I wouldn't be surprised to see if October's numbers continue to come in as the last couple of months have come in, which is employment is still strong and inflation is down. If those two things hold, they're going to have to probably drop 50 or even 75 basis points at least one time during the next four meetings. There's September, October, November, December still to come, because they need to get down at least 150 basis points to be kind of in parity with the market. Now there's a lot of things from a political standpoint going to shake up, that the Federal Reserve, Trump is going to, he's already removed one Fed governor. There's another in his crosshairs, and Jerome Powell, who's in charge, has frankly not done his job. And he has waited while everybody else in the world knew that interest rates need to drop because economies had strengthened. He has not chosen to push that button yet, and so his days are numbered. If nothing else, he's out next year anyway. He'll be replaced by somebody more friendly to the business community. In theory, the Federal Reserve is supposed to be an impartial third party, but like everything else, they get people in there that have views one way or the other, left or right, and it sways their ability to be able to make substantive decisions. And in this case, they've horribly mismanaged this process. We've talked about this before. I like to liken it to a couple of guys that came in to a Saturday night party late. They came in drunk. The party was almost over. They wouldn't leave when everybody else left, and they threw up all over the furniture. And that's what the Federal Reserve has done the last 2 years. They've been late to everything. When they came in, they did too little, and they can't get out of the way now. And so I think there's going to be some big changes afoot. Now, does this affect directly us? Yes, it does, directly in an indirect way. And the way that this works is Federal Reserve does not govern mortgage rates, but the 10-year T-bill is the basis now, and has been for the last 4 or 5 years, has been the primary basis upon which mortgage rates are built. The 10-year T-bill is fortunately governed by the will and the whim of bond and basically bond buyers, the bond market. And they have been able to raise and lower the interest rates just by the amount of demand and supply, and their withdrawal from the market. So when we get a Federal Reserve that also moves in tandem to what the market thinks, it'll be a lot more stable market. You'll see mortgage rates drop faster than the rate that the Federal Reserve drops. So in other words, you may see the Federal Reserve drop 25 basis points, but you may see a 75 basis points drop in mortgage rate, which would be substantial, because we're still sitting in the high sixes, low sevens. This market, for the economy we've got today, and for the way that the housing market's been built over the last 20 years, needs a sub 5% interest rate. We need a standard GSM government supplied mortgage, Fannie, Freddie, those kind of things. The standard conventional mortgage needs to probably be in the fours, maybe low fives, to make this market scream again. Those who've been involved in real estate from a profession standpoint, in other words, a realtor, appraisers, title companies, these guys have all been hurting. Most real estate investors have been hurting. If you do business the way we teach it, which is transactional engineering, it's the opposite. When the market is bad, we tend to do better because there's more motivated buyers. People have to sell for other reasons. So I'm seeing that as as a bright spot, because we do very well during this kind of market. And we, not that we don't do well during a market when interest rates are cheap, but when interest rates are cheap, all the buyers come to the market and all the sellers come to the market, and you're competing with lots of people. Today we're not. So it's a lot easier to sign up deals when the market is in turmoil, flux, whatever you want to call it. Anyway, that's we'll know more about that here in a couple of weeks. I'll keep you guys appraised of that as it happens, and we'll talk about it more.